Coming up today, the stock market hits new all-time highs, thanks to Nvidia overtaking Apple. Is this the top for Nvidia, or is it still early days? Jobs growth slows, an update on Roaring Kitty, a new Texas stock exchange, and global central banks begin cutting rates. I've got a real good one for you today, guys. Let's go. Hey, what's up guys? Jared here. Happy hump day. On this Wednesday, stock market S&P 500 breaking out to all-time highs, just like I'd been calling for ever since we got this big hammer candle formation to finish out the week. Last week, it was obvious to me the market was on solid footing and up with rip, and I've got a real interesting one for you today. And before I get into all of the stories, data, and charts, first off, let me just welcome everybody new to this channel. It's been a record amount of new subscribers come in over the last couple of weeks, and it's been great to hear from a lot of you. And for anybody else, if you're into trading stocks, want to stay updated with what's happening across financial markets and all the interesting stories we get on a daily basis, then hit that subscribe button if you haven't already, and you'll get these videos show up in your feed around 9 p.m. New York time. It's about 5 hours after the market closes each day. I make these daily market reviews, and if you watch them every day, I promise you'll get a good feel of what's happening across all financial markets. And my goal is to help you better understand what's going on, financial markets in general, and for you to have more success in your investing and trading decisions. And unlike other financial YouTubers, I respect your time and intelligence. I try and get these daily reviews wrapped up in under 20 minutes. I don't drag them out for 30 minutes, 40 minutes, an hour, just to try and generate more ad revenue. And in my opinion, if it takes you longer than 20 minutes to get a read on the market, then you're doing it wrong. I'm also not afraid to speak my mind and share my opinion and share with you guys investments and trades I'm also making. And I do admit when I get it wrong, because no one gets it right all the time. However, we've been nailing it lately. Not only do we have the S&P 500 breaking out to all-time highs here, all my daily regular viewers know I've been calling all year for Nvidia to become the world's largest company, and it looks like we are just a day or two away from that happening. Trading up another 5% today, tracking higher after hours as I speak, and depending on how Apple and Microsoft go over the next couple of days, once Nvidia trades above 1260, maybe 1280, it will officially be the world's most valuable company, as it just made it into the $3 trillion market cap club today, and just overtook Apple for the first time, which just made it back into the $3 trillion club today, after it'd been weak quite a few months now. It too looks on firm footing. And stick with me today because I'm going to come back into the charts, show you all the market internals, volatility, bond yields, commodities, and again I'll give you my specific thoughts and forecasts on where we go from here, and I'll tell you just how it is while keeping the fluff and filler to a minimum. First, let's just hone in on the story of the day, the hottest stock this year and potentially of our lifetimes. The ascent of Nvidia has been nothing short of absolutely incredible. Looking at a chart here of all stocks in the 3 trillion market cap club now, and their rise from under 100 billion 20 years ago, with Apple here in the red line, Microsoft in the yellow. They've pretty much been neck and neck for the last few years, and the long-time underdog, but has truly come out and showing its colors now. Nvidia here in the white, and so it looks like it's on the cusp of definitely becoming the world's largest company in the midst of this AI boom. And it's not all trading on hopium either. Nvidia does have the free cash flows to back it up, and you'll find that in the stock market over time. Nothing correlates more in the long run with stock prices than the underlying trends of free cash flow. And for those of you who don't know, free cash flow is basically what the company makes from its operational cash flow, revenue minus expenditures, and then minus capex, capital expenditures. So basically, after all said and done, how much cash is there available to shareholders in the form of retained earnings that can be reinvested, paid out in dividends, or with shares repurchased, all of which grows shareholder wealth in the long term. Looking at some valuation metrics now in Nvidia, it's actually got better valuation than last year and even in 22 and 21, because it's not only its stock price that it's exploded, it's also its revenue, its operating margins, and with all of that, it's free cash flow. And as much as we all like to hate on the guy, I've got to give it to Jim Cramer. He has been a perma bull on Nvidia for the best part of the last decade, and of course he doesn't always get it right, but he certainly nailed this one, and he even renamed his dog to Mr. Everest Nvidia back in 2017. So Jim saw what a monster it was years ago, and for that he deserves praise. Who else has diamond hands? There's none other than one of the best stock traders in Congress, Nancy Pelosi, along with her garden variety fund manager who she's married to. When he's not spending time with male prostitutes, he likes to take hot stock tips from Nancy, and one she gave him late last year was get in Nvidia in December. It was just weeks, and a month or two after that, we saw a lot of positive news developments come out from the government in regards to Nvidia, partnering with them, buying more chips, allowing them to sell a watered-down version of their chips to China, and she knew federal policy was supportive of American chip makers, with Nvidia leading the pack. And along with her husband, and her as a lifelong politician, that's blown out their wealth now once this gets updated to above $250 million. At the same time, helping to shape parts of her home city, San Francisco, into places that resemble third world countries. Anyway, I digress. Good on Nancy. She's done really well for herself, and she must be certainly proud of her gains here as well. And just stepping back a bit, Nvidia is doing a lot of the heavy lifting of this stock market year to date. It's actually responsible for a third of the S&P 500's gains. And something you'll see and hear about a lot is the stock market's concentrated, top 7 stocks, top 10 stocks, breaking out, with the extrapolation that that's bad. And again, you can look at it in two different ways. Of course, that can mean we're closer to a top than a bottom. However, for the here and now, like I always tell my viewers, short and medium term, going out the rest of the year, I'm bullish. However, long term, I think the US stock market, just looking at history and valuation metrics, is set to deliver subpar returns. But here and now, rising stock market concentration for the top 10 stocks, which reached 27% in 2023, right now it'd be around 30%. Looking back in history, that can persist for some time, like the 50s and the 60s. Stock market had a great performance. It was in a long 20-year secular bull market back then as well. Then it rolled over in the late 60s. Stock market topped out, and the 1970s was a lost decade in the stock market, and we can see concentrations were contracting in that time as well. However, they also expanded in the mid-late 90s. Again, another great time in the stock market, and then of course it rolled over again in the early 2000s. But again, there is fundamentals to back that up. Just looking at the profit of the top 10 by market cap and the rest of the universe, with the top 10 in the blue, all other stocks in the dotted black, that trend's actually been increasing this last 7 years as well, the amount of profit the top 10 make. And for last year, it was actually more than half and a larger percentage than any other time in the last decade. In other words, the strong are becoming stronger, the top 10 are making more money as a percentage of the overall market than they ever have done before. And that's not expected to go away anytime soon, especially now how dominant US big tech is around the world. All of us, at least in the Western world and many parts of the developing world as well, log into US big tech platforms every day, and that is unlikely to change anytime soon. And it's not just mega cap tech. We've got large caps and mid caps forecast to experience gross margin expansions during the next 12 months. Again, near some of the highest levels we've seen over the past decade. And believe it or not, the US stock market doesn't have the highest concentration when it comes to the top 10 stocks. In fact, Switzerland, France, Australia, and Germany all have much more concentrated stock markets. So it's not necessarily a bad thing. However, like I said, long term, it means we're on a path to the top, and nobody knows when that's going to happen. However, if I was to take a guess, I would say next year into 2026, we could still very well see a recession, and that could topple the stock market as well. But again, that's yet to be seen, because if the Fed goes on a massive quantitative easing version 5.0, then who knows? Anything's possible. We could really go to the moon before the whole public calls into the spotlight the Fed's policies when the top 1% own 90% of all assets, just like the path that we're currently on. And I'm sure some of you watching current day events will bring back memories, because back in the 90s, that was the decade of the internet revolution. And the biggest picks and shovels seller of the hardware behind the internet back then, Cisco Systems, briefly became the world's largest company, overtaking Microsoft back then as well, March 2000, before it then went on to a 90% plus drawdown over the next couple of years. So could this be the top for Nvidia, being the world's biggest maker of equipment that powers artificial intelligence? Well, not necessarily. History doesn't always repeat, but it can rhyme. And it's interesting the timing of this happening, because we've got Nvidia going into a 10-for-1 stock split this coming Monday the 10th, in which the amount of shares on the register will be multiplied by 10, and it'll be up to the market to then reprice them. And that's to help access to smaller investors, liquidity, especially in the options market. But also coming on Monday is Apple's Worldwide Developer Conference, which they're set to unveil the all-new AI-powered iPhone, in which some are describing could be a once-in-a-decade event, and this could be the time to get back into Apple. Been lagging in the NASDAQ for the last couple of years. Don't really have an AI product as of yet, and I can imagine they've been scrambling to hop on board this trend, with Wall Street analysts saying the upcoming AI-enabled phones, called IntelliPhones, could drive a multi-year upgrade cycle. With an installed base of over 4 billion smartphones, we see the opportunity for the next upgrade cycle to be a once-in-a-decade type of event. The AI-powered smartphones will offer superior personal assistance, language processing, health monitoring, improved photography, security, battery management, and AR/VR experiences. Bank of America rate Apple as a buy with a target of 230. Even more bullish is Wedbush Dan Ives, coming out with similar sentiment and an even more aggressive price target of $275 a share, saying he believes AI technology being introduced into the Apple ecosystem will bring ample monetization opportunities on both the services as well as the iPhone hardware front, and thus prompting him to increase his price target. There's a look at a clean weekly chart of Apple. definitely firming up here, and I'd have to agree. Up until recently, I had been somewhat bearish, if not neutral, on Apple, just given its valuation and declining growth these last couple of years. However, I think the analysts do have a point. This new series of iPhones and AI-powered stuff could get a lot of people upgrading. Just looking at myself, I haven't upgraded since 2019 my iPhone, so I'm probably going to get this one, and this could take them back to growth next year, if not at least get the market excited. And so I agree, I think we're about to break out above $200 a share on Apple, and I can no longer remain neutral on the stock going into this event and into new products. And even though the first version of their Vision Pro isn't the greatest, that's the case with all new products. Version 1 typically got a few bugs that need ironing out. They learn a lot from it, so they could still have a big hand in virtual reality, and they've just got such a huge installed base. They can pretty much enter any market and straight away crush it because it's Apple. However, that being said, they've still got a lot to prove to even justify current valuations, and would need to see some growth, and who knows, maybe those 10-15% growth numbers are possible in the next year or two, and that could certainly get the market excited and going on a run as well. So a lot of people are wondering, stock market in a bubble? Is Nvidia a bubble? Are we about to crash? Well, some research shows we still may be in the early stage of a bull market, as hard as that's to believe. With Ed Yardeni, positive S&P 500 forward earnings breadth gets walloped during recessions, but it soars during recoveries, which is what it's doing now. And we can see that in this chart, with the percent of S&P companies with positive 3-month percent changes in forward earning climbing higher. We've even got Goldman Sachs saying they see a wall of money fueling stock market's summer party, with a flood of cash from passive equity allocations set to pour into the stock market in early July and continuing through early summer. They also pointed to strong seasonal trends, something I've been highlighting to you guys, and seen a re-emergence in retail traders. And what's also interesting is looking back in history, the stock market has never peaked for the year in the month of June. Most of the time it happens towards the end of the year, as it naturally has less time to take out new highs. However, on the other side of the coin, there are 8 warning signs of a stock market bubble, and 6 of them have already flashed, according to UBS. They did say current conditions mirror more of that like 1997, not 1999, suggesting that we could go into a bubble soon, something I agree with. All the ingredients are there for a massive melt-up into a potential bubble top next year or 2026. However, looking at their signs that have flashed, the end of a structural bull market when equity returns have been very high relative to bond returns. Looking at profitability across the market, profit breadth called Nipper profits has apparently flashed as well, along with a large loss of breadth, which is true. We don't have the best breadth overall in the market right now. They also say we need a 25-year gap from the prior bubble. That's also true. Retail starts to participate aggressively. I'd say that's fair enough to call as being true. Monetary policy being too loose, well, that's up for debate as well, but I agree. The Fed hasn't started cutting rates just yet. An extended period of limited decline, and that hasn't flashed. In previous stock market bubbles, they saw a multi-year period of limited sell-offs of less than 20%, whereas we just had one in 2022. And so that's true. The good times have to roll on quite a bit before it causes a massive society-wide pylon like we saw in 1999. So all in all, I'd agree. We've got plenty of signs there long-term that the next 5-10 years may not be the best for stock investors. However, there's still plenty of room for it to run higher into a bubble peak. But like I said, we also don't have the best breadth right here. Today we got the Nasdaq closing at a record high, with actually the amount of stocks hitting 52-week lows eclipsing that of those hitting 52-week highs. Looking back in history, stock market on average is lower 3 months later, pretty soft performance 6 months and 12 months later compared to normal trends as well, especially in an election year and other price seasonalities that we're currently hitting. So that's something interesting that goes against the current bullish grain. And like I said, here and now we've got a lot of momentum carrying this market. Could go higher, stepping back in the long term. Like I'll always give you guys my short, medium and long term forecasts, just looking at equity risk premium. That's the premium of S&P 500 forward 12-month earnings yield. So if a stock's got a PE of 20, that's an earnings yield of 5%, minus the 10-year bond treasury yields, now pretty much down to break even. So going forward, the actual yield you can expect from stocks is about the same from the 10-year. And that's typically associated with poor returns going forward. It's much better like in early 2009 and 12 and March 2020 and COVID, when stocks are yielding way more than bonds. However, like we saw in the late 90s, that can persist for some time. Go for a couple of years, actually almost got down to negative 300 basis points by early 2000 when the market finally topped out. And again, another sign that this bull market could have further to run, although the long-term forward returns probably are not going to be that great. And like I always say, if you're worried about that, one of the best ways to insulate from poor returns going forward is diversify not only into different asset classes like commodities, but also diversify geographically as well, across the world. US is near the top when it comes to valuation, price to earnings, especially against the 15-year medium reading. However, going down to the bottom of the list, there's Turkey, which I wouldn't invest in, but interesting. And again, my daily viewers know, market I've been bullish on since late last year, ever since Xi Jinping stepped foot onto US soil, met with business leaders, is China. And even though they're leading international stock markets this year, they're still second bottom on the list, has been most cheap. Another one I've also mentioned to you guys, the commodity-rich nation of Brazil, really cheap, and possible maybes. Italy, Greece, no. South Africa, no. Maybe Poland, and Israel, possibly. However, as we all know, that's full of risk. And I'd even go as far to say is South Korea and Singapore look pretty good as well. Typically want to invest in growing and relatively stable economy. But as we approach the halfway mark this year in the States, looking at the economy and the market, so far so good. We could be getting that soft landing. Labor market, economy gradually pulling back, which could very well pull back inflation with it, allow the Fed to pull back rates, and the market can just drift higher. No big surprises, no big sharp spikes in unemployment rate, well not yet anyway. But we are seeing some softening signs in the jobs market. Looking at the ADP jobs report, which looks at about 24 million private sector jobs from a company called Automatic Data Processing. Looking at that large segment of the US jobs market, economists are expecting that category to add 175,000 new jobs in May. Actually came in 152,000, significantly lower, showing that the jobs market could be softening a bit here. We'll get a better look at that on Friday when we get the non-farm payrolls report. The big headline jobs number and unemployment rate could very well come in at 4%, higher than expected at 3.9. However, overall, consumers are still doing okay. Just looking at this long-term chart over the last 20 years, with the amount of new foreclosures and bankruptcies still actually below 2019. It's not climbing up here at all. And like I've also been saying lately, we're getting contrasting economic data. It's not all moving in the same direction. We saw that again today with the ISM Services PMI actually climbing up to a new 7-month high. As manufacturing and spending on infrastructure data centers as well has been coming back. However, the market's paying more attention to that soft jobs data. We can see that with Treasury yields pulling back today and Fed fund futures firming now to about 70% chance the Fed will cut in September. And that's what had also signaled to me to get bullish on the stock markets. We got these bond yields swiftly pulling back just after they'd been marching higher. A few soft economic prints, and they know Jay Powell, Janet Yellen will come after them if they go too far above 5%. Here we are today, 473 on the 2-year, and the 10-year losing a technical support level as well, down at 428. However, is it all just that soft economic data, or are they sniffing out something a bit more, possibly unrelated to an inflation? As a recession would certainly catch the markets and a lot of people off guard here. Really not good timing either going into an election, and things could be taking a bit of a turn just looking at economic data in the macro, not looking at the tape. With the Atlanta Fed GDP forecasts falling off a cliff these last couple of weeks, really lowering how much they think the US economy is going to grow in the second quarter and for the rest of the year. And it's possible the commodity markets could be trading on the same narrative as well. Got a sharp pullback in oil, copper as well. It did find a little bit of footing today. However, when the economies pull back, so does demand for commodities. They can often come down hard with a recession or going into a recession. As looking at crude oil has come off really hard this last week or so, and it may be a bit more than just the Biden administration threatening to release more strategic reserves, and OPEC, even though they did extend their cuts out to September, wasn't all that bearish for the market. Maybe the price action in commodities and bond yields is telling us something a bit more. Same with copper as well, losing its 50-day. And the spread I like to track, global economic growth, copper versus gold, also losing its 50-day. There's something we'll keep an eye on. Like I always say, the technicals lead, the fundamentals follow. And so while the stock market's definitely excited with these lower bond yields in oil, typically the stock market is more late to catch up with the economic reality, and the bond market can often lead as it's much larger and full of more sophisticated investors. And we've also got bond market volatility marching back higher this last week as well. Whilst we've still got stock market volatility pretty much on the floor here, 12.6. Volatility risk premium trading a little moderately there, not too low. And like I said, overall breadth isn't the greatest. S&P 500 equal weight isn't breaking out, nor is the Russell 2000, and we've still got more than half of all stocks actually below their 50-day average. It's really the Magnificent Seven, which we can see in this composite chart here. Like I said, pretty much doing most of the heavy lifting in the main indices of S&P and NASDAQ. And that's why I continue to believe for those main indices to roll over, we really need to see Nvidia roll over, which who knows could happen on Monday in tandem with the Worldwide Developers Conference from Apple. There could be the liquidity event for big funds to shuffle their hands and take some profits. And I'd say that looks like the way we're shaping up. But we've still got 2 more days left in this week, and we could continue ripping into Friday, especially if we get a soft jobs report. Not too soft to get fears of recession going, but soft enough to firm the odds of a Fed rate cut. Market could rip going into the weekend, and then Monday could be a sell the news event. But like I've been saying with Nvidia and its path to becoming the world's biggest company in this AI boom, it's like a moth to a flame. Seems almost inevitable, doesn't it? Moving on to the other biggest story in financial markets this week, that of Roaring Kitty, aka Keith Gill, suburban retail trader, going all in on GameStop, struggling business, building his position somewhere around $250 million. And wouldn't you know it, GameStop finished up 19% today and even tracked a little bit higher after hours. Post-market just shut, helping to get other meme stocks like Reddit moving higher, AMC still hanging in there, and Robinhood ticking up as well. Just looking at Keith Gill's account over on Reddit, he hasn't posted any updates since 2 days ago, which I think he's still holding onto both his positions in the common stock and his $20 strike call options as well. Because just looking at volume data in that strike, didn't appear to have any big volume there today, indicating that he's got out. So he's most likely still holding here. And of course, the establishment and the swamp are not happy at all. And this guy posts his positions, making all this money. He's just supposed to be a retail suburban trader. Get the hell out of here, they're saying. Only those in Congress and on Wall Street are allowed to manipulate the market for hundreds of millions of dollars. Former SEC prosecutor thinks it warrants an investigation of him posting memes online and sharing his account, saying it's clearly market manipulation, and this will be very interesting. And who knows, he may have thought this well and truly through. He's a very smart guy. He may be happy to take this to court. Certainly got the budget to fight anyone and may be able to shine a light on some of Wall Street's practices. And while he's there, let's talk about Congress trading as well. Or will it be another case of selective punishment and rules for thee, but not for me, which very well could happen again. And because of that selective punishment, the ideologies of a certain faction of society pushed on upon us, especially coming out of New York, that's prompted a group backed by Wall Street heavyweights BlackRock and Citadel to start planning a new national stock exchange in Texas to try and take on New York Stock Exchange dominant. And what they see is over-the-top regulation and a lot of worrying signs and trends coming out of New York regulators and laws, along with what's happening on the ground. With some saying San Francisco is going the way of Detroit and New York's going the way of San Francisco. And we've seen other companies leave New York and California, most notable Tesla relocating to Texas, where they feel more protected by the law and probably more importantly, the spirit of the law instead of one-sided technical enforcements. And I'm not normally one to stand in the same corner as BlackRock and especially Citadel. However, me personally, I 100% support this move and hope we see a new stock market in Texas. I think it'll be great competition for New York. Keep them on their toes. And don't get me wrong, New York's a great city. I've been there a couple of times. It's just some of the current local government are continually making more and more anti-business moves. And so I think it's healthy for capital markets and us investors, for them to have some competition coming out of Texas, I think will be a great thing for us all. Anyway, that's just my opinion as always. You don't have to agree with everything I say. Be sure to let me know your thoughts and opinion in the comments below this video. I'm interested to hear what all you guys think about this one. And do you think it'll be a good idea for there to be a stock exchange in Texas competing against that in New York? And wouldn't it be great if Roaring Kitty used all his money to start a stock exchange? I think he could offer some competition for New York as well. Moving on, we've got global central banks starting to cut rates. We saw that a few months ago with Switzerland and Sweden. Now the next biggest economy to do it, Bank of Canada today, trimming their rate 25 basis points as predicted, pointing to signs of softening inflation. They do have lower growth and economic strength than America as well. And just looking at the inflation adjusted GDP per person of Canada versus the States, unfortunately, ever since Justin Trudeau took office in late 2015, that's broken away, and there's pretty much been no economic growth for the average Canadian when adjusted for inflation in that time. Well, America's been ripping ahead, and as a lot of Canadians will tell you, the cost of housing is also out of control. However, I don't think Justin's too worried, as he's part of the 1% himself, and like many people accuse him of, is more interested in pushing his ideologies upon us all than improving the underlying economic health for the average Canadian. Up next is the ECB tomorrow, likely to cut rates as well. The world can kiss goodbye 2% inflation targets, as 3% is the new 2%, and the Fed could very well likely follow suit, especially if we get soft jobs print on Friday. Who knows, they could cut in July, if not September, especially with the way oil's going. That very well could bring down inflation in the near term here. Even though we may have structurally high inflation in the long term, the here and now, oil and commodities pulling back, softer consumer, even though we've still got good business spending and manufacturing, could definitely be grounds for the Fed to cut rates soon. And funny enough, the fear and greed index, the low end of the neutral zone, even though the stock market is breaking out to new all-time highs. And that just goes to show the disparity between the mega cap tech and the overall market, looking at net new 52-week highs and stock price breadth. It's just not there yet. The whole stock market is not bubbling higher. It's really just a handful of names or so. But corporate insiders could be coming back. Did a bit more selling yesterday than usual 244 sales versus 57 purchases. And there's a look, 10-year bond yields around the world. United Kingdom, 418, Eurozone 250, Canada really pulling back on that decision today, 338, Australia at 419, Japan's 10-year holding firm at 1%, and China at 2.3. The Fed is going to cut rates, and this could ignite a further rally in TLT, one of the most sensitive bond funds to the change in interest rates due to its long duration. Investment grade corporate bonds breaking out a multi-week high as well, and high yield bonds still holding firm. Dollar looking a little soft there, and Bitcoin on the cusp of breaking out to new all-time highs as well, which I wouldn't be surprised if we get that going into this weekend, especially if the S&P and Nasdaq keep ticking higher as well. Gold still not doing much, consolidating. China seeming to find support at the 50-day. One of my favorites, Tiger Brokers, just reported, came in a little softer than expected on both the top and bottom line. Market didn't seem to worry too much. We'll see how it trades tomorrow. I'll have a further look at that. Clean energy still holding onto its uptrend, and there's semiconductors. Winning ETF today thanks to the absolute smoke show of Nvidia and a little bit of a pullback actually in staples and utilities. Cannabis still trying to find its footing here, and typically when markets don't bounce straight away, could mean a little bit more softness, so we actually might come down, test this 730 support zone from mid-March. We'll keep an eye on that one. And just looking across the rest of mega cap tech like Microsoft having a good day, Amazon ticking up, Alphabet, Google as well, Meta having a good day, and Tesla also consolidating. And major financials not really getting a whole lot excited by these lower bond yields they had been really reacting to this last little while. Seem to be stalling out here a bit. Okay, so there we are for this Wednesday. New all-time highs in S&P 500, and that's thanks to the star of the show, Nvidia, which technically speaking looks super strong. However, we could be on our way to possibly a short-term top. Who knows? Maybe the top. We do have the big psychological event of it becoming the largest company in the world. In addition to their stock split on Monday and the Worldwide Developers Conference with Apple as well, we'll be looking for price action. Maybe we get a big spinning doji top, follow through the next day, island reversal. As always, we'll be following the tape, following the data, and I'll keep doing my best as to what to make of it all for you guys. So thanks very much for your support. Hit that like button and sharing your thoughts below. I'm interested to hear what you guys think about all this as well. And let's see what we get tomorrow and going into the weekend. Thanks very much, and I'll see you again tomorrow. Cheers.